It's Josh. I'm here with Michael Batnick. Michael, I know you saw my blog post this morning. I was talking about this Bloomberg article where they were talking about the Fidelity Magellan Fund, which is a really good fund, and it's been around for a long time, and it's famous, and it's been doing really well for 6 years, but they're actually barely raising any money or losing money, and it's been losing money for almost 2 decades. And I don't think it has anything to do with how they're managing money for clients or what they're doing with the fund or its alpha. I think it's just kind of like a casualty of the way the industry has been shifted. And now people are looking more for reliability and tracking error, and they're looking less at, is this fund earning more than whatever benchmark it's up against? And I know you see that in your research all the time.
So previously to the generation that we're in now, it was wirehouse brokers, and their value add was outperformance, picking the best stocks and then picking the best mutual fund managers. And that's no longer the case. And I think a function of that might be where the clients are in terms of like just stages in their life.
Oh, you think it's like demographic, like they're so close to retirement or in it that they're not even looking to take shots on something that could beat the market?
So if a client is approaching retirement 20 years ago, they were probably maybe a little bit more concerned with outperforming the market. But at this point in their life, they want different things. They're not focused on, their goals are not to beat the S&P 500. Their goals are to not worry about finance, to live a fruitful life, to enjoy themselves. And I think that index funds are a really good solution in terms of, from the advisor's point of view, you know what you're getting, for better and for worse.
Right, so you know even if we get a 25% decline in the stock market, you know you can expect something on the order of 25% if you have an S&P 500 index fund. But A, that's not going to be your whole portfolio. And B, if you had an active manager who only lost 22, within the asset management industry, he'd be high-fiving people, or she'd be high-fiving people, but in real life, that doesn't help anyone.
Yeah, I mean, if a client says to you, I'm down $800,000, well, the good news is you outperformed by 300 basis points.
You would have been down 900,000 if you owned the index.
Right. So it's more predictable. It's easier to explain.
Right.
If you're going to get all the upside, obviously by definition, and you're going to get all the downside too.
So Eric Balchunas, our friend at Bloomberg, who covers ETFs, did this thing about how the money leaves both. Right. Like in a market downturn, it doesn't matter what kind of fund you are, you'll probably see outflows, with some exceptions, but then when it comes back to the lowest cost, simplest version, and it doesn't go back into the alpha oriented funds. Why would the next market downturn change that dynamic?
And after the 73, 74 bear market, there was outflows for 22 straight quarters. And then when it came back in, it went to the Fidelities of the world.
Right.
And now I don't think that's going to happen again.
Right. So people are like, ooh, if you're in index funds, you're going to panic and you're going to sell out at the bottom. Aren't you going to do that anyway, no matter what you own, if that's your personality?
Yes, and people aren't going to sell because the market is down 35%. The market is down 35% because people are selling.
Right. It's not down and then someone's selling.
Right.
That's what makes it down.
Right.
And it doesn't matter what they sell.
Right.
But like if that's how you're managing your money, where it drops and you get out, you could own anything.
Yeah. So I don't necessarily know that behavior is going to be better in an index fund in a bear market than an active fund, but when it does come back in, it's probably going to come back into an index fund.
So here's where things get really interesting. So the active shops, their whole spiel right now is wait till the downturn, and it turns out that actually might be the worst possible thing that could happen for them, just historically, based on money leaving and then not coming back.
Right.